Welcome to the Deep Dive. Today we're digging into Apogee Enterprises. They just had their fiscal 2026 second quarter earnings call.
And it's a really interesting one, kind of a paradox, actually.
Exactly. You look at the Q2 results and, well, it beat expectations pretty significantly too.
Yeah, a solid beat. But then you look at the stock reaction down over 4% on heavy volume. So something spooked the market.
Right. So our mission today is to figure out what that something was, go beyond those headline numbers, look at what management actually said about the future.
What were those risks that just overshadowed that nice Q2 performance? That's what we need to unpack.
Okay, let's start with the numbers then. The snapshot. Where did they win in Q2?
Well, like you said, they beat on both the top and bottom lines against consensus.
Non-GAAP EPS, that came in at 0 to 98 cents. The street was looking for, what, 0 to 84 cents? So that's a $1.14 beat.
Yeah.
Pretty substantial.
It really is. And revenue was solid, too. $358.2 million. That's up 4.6% year over year.
And also beat the consensus, which was near $352 million.
Yeah.
So on paper, a good quarter.
Absolutely. Operationally, looks like they were executing quite well. But the market reaction tells the real story here.
It always does, doesn't it? Investors are looking forward, not back.
Precisely. And the big worry, the reason for that sell-off boils down to margin compression. That and the lowered guidance for the full year.
Ah, the guidance. Okay. So let's talk margins first. What happened there?
Well, the adjusted EBITDA margin, it dropped pretty significantly, down 310 basis points compared to last year, landed at 12.4%.
Ouch. So revenue up, but profitability squeezed.
Exactly. Management did well executing, but they ran into some serious headwinds. Think commodities, specifically aluminum, and just really tough pricing competition. Those forced their hand on the full year outlook.
Okay, let's break down the business segments then, because it sounds like a tale of two companies here. Some parts doing well, others not so much.
That's a perfect way to put it. It's really bifurcated. You absolutely have to start with the star performer, performance service.
Right, the growth engine. What drove that?
Two main things. First, you had the acquisition of UW Solutions kicking in. That added about $24.9 million in revenue. Inorganic growth.
Okay, acquisition boost. What about organically?
That was strong, too. Really strong, actually. 18.6% organic growth. Management said that was mostly from better distribution, particularly through retail channels.
And the pipeline there. Does it look solid going forward?
Very solid. The services backlog grew 16% just from the previous quarter. It's sitting at $792 million now.
Wow, nearly $800 million in backlog. That's some serious visibility.
It really is. And that's crucial, having that guaranteed revenue stream when other parts of the business are facing these cyclical pressures.
Let's pause on that UW Solutions piece for a sec. You mentioned it's flooring. What's driving the demand there? Is it just general construction?
No, and this is where it gets quite interesting. It's not just basic construction. A big driver is automation.
Automation. How does flooring tie into that?
Think about modern warehouses, huge distribution centers. They're increasingly using things like automated guided vehicles, AGVs, robotics.
Okay.
Well, these systems need specialized, often very flat and durable flooring to work properly and reliably. UW Solutions provides that.
I see. So it's linked to infrastructure upgrades for efficiency, not just building new sheds.
Exactly. And management even mentioned seeing demand pulled into Europe by a, quote, large global e-commerce retailer. We can probably guess who.
Right. Building out those massive fulfillment centers.
Precisely. So it feels like a more structural demand driver tied to automation and e-commerce logistics, which is, a bit stickier than general construction trends.
That makes that services segment sound pretty resilient, almost defensive in a way.
For the near term, yes. But then you pivot to the other segments.
Glass and metals. Yeah. And that's where the story gets tougher.
Much tougher. These are the legacy businesses really feeling the headwinds. Let's take glass first.
What's the picture there?
Management's guiding margins there to normalize, sort of settle into the mid-teens range, which historically isn't terrible for them.
Mid-teens is okay, but what's limiting them?
Competition. Aggressive pricing out there is capping their volume growth.
So are they cutting prices to keep volume up?
No, and this is key strategically. They're being disciplined. They explicitly said they're not going to chase volume if it means wrecking the industry's pricing structure.
Protecting the premium.
Yeah, they want to maximize the actual EBIT dollars, the profit, and keep that premium margin floor intact, even if it means letting some volume go in the short term.
So demand, like bid activity, is still there.
Apparently bid activity is up, but the competition is just pricing very aggressively to win those bids. It's a tough spot.
sacrificing some top line now to protect long-term profitability. Makes sense, but probably doesn't feel great quarter to quarter.
Definitely not.
Yeah.
And that leads us straight into the metals segment. Similar story, but with a specific twist.
Okay, what's happening in metals?
Well, they actually saw some sequential improvement on the top and bottom line. Those tariff-driven price increases they pushed through earlier finally started to stick.
But there's always a but.
There's always a but. The but here is volume. As soon as those higher prices really flowed through, volume took a significant hit. And that brings us to the core problem.
Let me guess. Aluminum.
Bingo. The aluminum problem. It's a massive input cost for them, obviously.
And costs went up?
Not just up, they surged. On average, about 20% higher during Q2.
20%. Wow. Okay, that explains a lot of the pressure.
It really does. It puts immediate severe pressure on both pricing and volume for the rest of their fiscal year.
And the timing is tricky with construction projects, right? Long lead times.
Exactly. That's the crucial mechanism here. You bid on a project, you sign a contract based on aluminum costing X.
But by the time you actually need to buy the aluminum, maybe 6-9 months later.
It costs X plus 20%. And your contract price is already locked in.
So you have to eat that cost difference, especially in the near term.
You got it. That lag means they're going to feel significant margin pain in metals, particularly in Q3, on contracts already signed.
So how do you manage that? Cost spiking, contracts locking you in, competitors maybe pricing aggressively?
It's incredibly difficult, and the only real answer management had was reset expectations.
Which brings us back to the guidance cut, the thing that really tanked the stock.
Yep. Let's look at those updated numbers for fiscal 2026. Net sales, they pulled that down quite a bit, now expecting $1.39 billion to $1.42 billion.
Lower than consensus was before the call, for sure. And the earnings per share.
Adjusted EPS took an even bigger hit. The new range is $3.60 to $3.90. Prior consensus was closer to $3.96, maybe even a touch higher in some models.
So a definite haircut to expectations. Did they quantify the headwinds?
They did, which was helpful for analysts. They specifically called out the estimated EPS impact just from tariffs, mostly related to that aluminum issue at $0.35 to $0.45 for the year. 95
to 45 cents just from tariffs.
That's huge. It's a massive chunk of earnings. And on top of that, they flagged another issue, higher than expected health insurance costs hitting in the second half, sort of an internal headwind piling on.
Okay, so multiple pressures converging. What did they say about the timing, the cadence through the rest of the year?
They were pretty clear. Expect Q3 adjusted EPS to be basically flat, similar to Q2. Any sequential improvement isn't expected until Q4.
And that Q4 improvement driven by?
Primarily by performance services, that strong backlog converting. They're essentially telling you Q3 is going to be tough sledding for glass and especially metals.
So facing these headwinds, what are they actually doing about it, besides cutting guidance?
Well, they're not just sitting back. They talked about ongoing efforts to mitigate the tariff impact, sourcing strategies, negotiations.
And did they mention Project Fortify too? What's that?
Right. Project Fortify 2 is their internal efficiency program, basically focused on cutting costs, improving processes in their manufacturing plants, trying to find savings internally to offset some of that external pressure.
So belt tightening and operational improvements. A defensive move.
Exactly. And financially, the underlying company is still pretty solid.
How so? Balance sheet, cash flow.
Yeah, balance sheet looks healthy. Leverage ratio is only 1.5 times consolidated debt to EBITDA. They generated good cash from operations in Q2, $57 million.
And they're still talking M&A.
Yep. Reaffirm the focus on strategic bolt-on acquisitions, likely in that services space, given the momentum.
And the dividend, always a key signal.
They reaffirmed it. $0.26 per share, payable in November. That's a sign of confidence, or at least commitment, despite the near-term turbulence.
Okay, so we have this real split screen. Resilient, high-growth services with a huge backlog.
Versus the legacy manufacturing side, glass and metals, getting hammered by costs and competition, even though they're trying to be disciplined.
It's a complicated picture for investors, which naturally leads us to
our favorite segment.
Our This Is Not Financial Advice segment, where we brainstorm a, let's say, creative trade idea based on this divergence. What have you got?
Okay, so disclaimer firmly in place. This is complex, high risk, not for everyone. But given that 4.4% drop,
which felt like maybe an overreaction.
potentially, especially given the visibility in services. You have that $792 million backlog there versus the very clear cyclical commodity pain in metals and glass. So the idea is a pair trade, an internal hedge, if you will.
Okay, intriguing. Pair trade. How?
The core thesis is this. The market is maybe over-discounting the strength and predictability of that services backlog, while it's probably correctly pricing in the commodity risk for the rest of the business.
So isolate the good part, hedge the bad part.
Sort of. The action would be go along Apogee stock itself. You want exposure to that services upside, the backlog conversion, and management's pricing discipline in glass, hoping they navigate it well.
Okay, long the stock.
Right.
But that still leaves you exposed to the aluminum problem.
Right. So at the same time, you short something that represents that cyclical commodity-exposed part of the market.
Like what? An aluminum ETF.
You could, but maybe more targeted. Short a basket of Apogee's regional competitors, specifically those heavily exposed to aluminum and non-residential construction, maybe ones without Apogee's strong services diversification or margin discipline.
Ah, I see. So you're betting Apogee outperforms its more purely cyclical peers.
Exactly. If services delivers on that backlog, and maybe aluminum costs even ease up a bit, Apogee stock should do well, potentially better than the basket you're short.
And if aluminum costs keep surging and that $1.35 45-cent tariff headwind hits hard,
then Apogee stock likely suffers. But your short position on the even more exposed competitors should gain value, offsetting some or maybe even all of that loss. You're hedging the macro risk by betting against the sector while betting on Apogee-specific execution and diversification.
it's definitely a sophisticated way to play the divergence. Capitalizes on the services strength while trying to neutralize the commodity exposure. High risk, high complexity, but plausible.
Plausible, yes. Financial advice, no.
Absolutely not. Okay, wrapping this up then. A really fascinating quarter for Apogee, strong execution, especially in services, meeting some pretty brutal macro headwinds head on.
Yeah, and, they are arguably in a better position than in past downturns. Management pointed out glass margins are expected in the mid-teens now versus maybe low single digits in the last big cycle, so there's underlying improvement.
But the key thing to watch now is Q3, right?
Absolutely. Two critical signals for the next earnings print. First, can metals start to find that balance between price and volume, or do they keep bleeding share to protect margins?
And second,
how efficiently does that big services backlog convert? Do those projects maintain the high margins they've been getting? That combination will really dictate the narrative.
does it shift back to Apogee being a resilient cash generator, or does margin compression remain the dominant theme, keeping a lid on the valuation?
That's the million-dollar question, isn't it? Or, well, the $792 million backlog question.
Indeed. That tension between structural resilience and cyclical pressure is what we'll be tracking. Thanks for joining us for this deep dive. As always, we encourage you to check out the source materials yourself.